What is the impact of inflation on borrowing money? Imagine you're planning to buy a house or a car and wondering how rising prices might affect your borrowing plans. When prices go up over time, it can change how much you pay back on loans. Inflation means that the overall prices of goods and services increase, which reduces the value of money. If you borrow money now and inflation rises later, the money you pay back is worth less than when you borrowed it. This can be good for you because you end up paying back with dollars that have less buying power. For example, if you take out a mortgage today and inflation increases over the years, the amount you owe stays the same, but the money you use to pay it back is worth less. That means your debt becomes easier to handle in real terms. But inflation also pushes lenders to increase interest rates to protect themselves from losing money. When interest rates go up, borrowing becomes more expensive. So, if you want to get a new loan during a time of high inflation, you might face higher monthly payments because lenders want to make sure they earn enough to cover the inflation risk. This is especially true for long-term loans like student loans or auto loans, where interest rates tend to rise with inflation. The type of loan you get matters a lot. Fixed-rate loans keep the same interest rate throughout the loan period, so your payments stay steady even if inflation rises. But if you have a variable rate loan, your interest rate can increase as inflation pushes rates higher, making your payments more costly over time. Another factor is wages. If your income increases along with inflation, it can help you keep up with higher payments. But if wages stay flat while prices rise, paying back loans can become tougher, squeezing your household budget. Overall, inflation can make existing debt less burdensome because the money you pay back is worth less. But at the same time, it can make borrowing new money more expensive due to higher interest rates. The impact depends on how inflation interacts with wages, interest rates, and the type of loan you choose. This is why understanding inflation is key when making borrowing decisions and planning your finances.